All right. Good morning. I think we're live. Good morning, everybody. Thanks for joining. This is our Energy Edges Q3 update on the energy landscape. I'm Neil Hendricks. I'll be moderating the session. And just so everybody knows, today is Checkered Shirt Day officially because we did not plan this. Somehow it worked out. I'm joined by, of course, the experts, Andy Kyle, Matt Hobson, and we're going to cover quite a bit of material today because there is quite a bit to talk about in the energy markets. Just a reminder, too, this session is being recorded and will be available at the end of the event today. So traditionally, I would say at this time of year, a quarterly update would be focused probably on how we are out of the summer and looking ahead to what winter has in store for us. And we'd be keeping an eye on things like natural gas and predictions for a winter forecast, and maybe even any lingering tropical activity for hurricanes and that sort of thing. But today's update is going to cover quite a bit more because the fundamentals to energy have become quite multifaceted. There's a lot going on in regulatory space. Certainly, the gas discussion continues to be pretty bullish. And then things like data center load growth and what's the state of renewables. All of these things are probably on your minds and certainly in the atmosphere as far as topics of discussion. So we'll be covering a lot of that today. Our agenda, of course, as follows. We'll cover the regulatory stuff, natural gas, and then we'll look at each of the markets as we do exit the summer, do a quick review, and then see what's ahead. And of course, this is meant to be interactive, so as questions come up, please submit them, and we'll cover them as we go along. So, to get started, Matt, I think you take it away.
Yeah, for sure. Yeah, thanks, Neil. And fair to say, the one thing that's not on our mind these days is baseball around here, right? I think all of our collective teams are out of the playoffs.
Yeah, and I'm just trying to get over that. I'm trying to keep it together for this, and you bringing that up. So
I'm sorry. Well, I've shifted my focus to college football, so
oh boy,
and hockey's about moving on to greener pastures.
That's pastures. Right. Fantastic.
So in the category of things that are exciting, always fun to kick off with a policy update. Certainly an area that's been very active, really, for the entire year and probably even going back beyond that. So if you rewind back to when we had our last webinar, obviously we spent a decent bit of time talking about what was then sort of the beginnings of what ended up being the One Big Beautiful Bill Act. A lot of uncertainty at the time about exactly what direction things were going to go, but we now have more clarity, certainly with the passage of the bill. And it goes without saying that, very significant changes to the clean energy landscape, clean energy incentives that are coming from the federal government. So just to kind of high level on that, I think probably most folks are familiar, but the big takeaway, couple big takeaways. So the investment tax credit, the production tax credit for wind and solar projects is going to be eliminated on a much faster timeline than what was originally called for under the IRA. So under the IRA, those credits were in place really to 2036. 2032 was the headline year. However, projects could safe harbor and have an additional 4 years. So conceivably had a very long runway to develop projects over the next, decade plus. So OB3 is changing that significantly. So those tax credits will go away basically for projects that either are not placed in service by the end of 27 or have started construction as of July 3rd of 2026. And then from there, they would have 4 years to complete construction and come online. So I'll come back to that because there were some pretty big changes as well to those safe harboring rules. So much accelerated timeline on getting development done. Notably, the credits do stay at their current levels through those deadlines. So if you recall, some of the discussion was about potentially reducing those credits, kind of stepping them down over sets of years. Not where things landed. Basically, the credits are fully in place until those deadlines, and then they're fully gone for solar and wind projects. Notably, though, geothermal, nuclear, battery storage, all of those are unchanged in terms of timelines, as well as in terms of the amounts of those credits. So another thing that the bill put in place was some new requirements, some new restrictions around basically projects that are qualifying for these credits receiving assistance from foreign entities of concern. And really the notable one here is China. There's a lot of think kind of supply chain implications here, because in essence, material assistance, yes, you can think ownership, but really it's also supply chain components coming from those countries. So a lot of concern about what that's going to do in terms of supply chain, ability to get components, costs, and sort of a need to sort of move things around. But bottom line here, clearly a big change in terms of what we expect to see from a wind and solar perspective. So maybe zooming out a little bit and just talking more broadly about federal power policy themes that we've seen even beyond OB3. A lot of focus on conventional or dispatchable generation. Several things that have come out from the EPA. One, elimination of the proposed GHG or greenhouse gas limits on power plants. If you recall, there were some pretty restrictive rules that were planned to come into effect that would have required new gas plants to have carbon capture associated with them, older plants to even retire early or add carbon capture to them. All of that's now off the table, as well as some additional rules, cross-state air pollution and things like that. Those are going to be softening, which, again, I think the theme there is trying to keep thermal capacity online and incentivize new thermal capacity, or at least take down barriers to getting new thermal capacity in place. We did see the Department of Energy over the summer, or at the beginning of the summer, step in and sort of force some planned plants that were planning to retire before the summer, coal and natural gas plants specifically, to stay online for reliability reasons. That was kind of the first time, I think, at least in my memory, that we had seen the Department of Energy step in and make a decision like that, as opposed to what you typically see, which is an independent system operator or even a utility, making those decisions. So I think that's something that we expect to see probably more of as we move through time. The administration's made a clear effort to try to keep thermal generation, coal and gas specifically, online. We talked a little bit about some of the different grids that are pursuing fast-track interconnection processes. That's continued, and there's been some updates there, which we'll talk about as we move through the ISOs. And another notable thing, a lot of new, even beyond the changes to the tax credits, new procedural hurdles to wind and solar projects. So think things like Department of Energy, Department of Defense, FAA approvals. All of those have gotten a lot more challenging for new solar and wind projects. And of course, everyone's seen probably the headlines around some of the different offshore wind projects that have been ordered to stop construction. That's been an area that's been certainly challenging in terms of offshore wind. We talked about the tax credit changes, but in addition to that, there's been a number of federal loan and grant programs for renewable projects that have been canceled or defunded. There were also some new restrictions put on tax credit transfers, which has been a pretty significant source of sort of cost reduction in terms of having that ability versus projects only being able to go after sort of traditional tax equity financing. And then lastly, trade policy. In addition to the foreign entity of concern changes, we do now have anti-dumping, anti-circumvention tariffs on several key solar panel components from the countries that were sort of under the microscope over the last couple of years. And then, of course, the broader reciprocal tariffs, definitely have some impacts as well. So summing all of that up, a lot of uncertainty about the makeup of what we're going to see from a new build generation perspective. Obviously, gas is going to be a meaningful part of that equation, but I think, as we're probably all hearing, a lot of concern about the supply chain for natural gas turbines. How quickly can you get those things built and online? So a lot of uncertainty for sure. Tariff exposure definitely adding costs, and I wouldn't say that that's limited only to wind and solar projects. Things like transformers and other components that go into really any type of generation project and/or new large load, those are seeing upward cost pressure as well. Also, just from a demand perspective, for sure. I think with the accelerated timeline, for those tax credits to expire, we definitely expect a very sort of condensed development period. So expect a lot of, especially solar, but also some wind to sort of get accelerated to try to get online ahead of those new deadlines. And we'll talk some more about the implications of that here in a second. And then lastly, with the sort of push to get new, especially data centers, but more broadly, new large loads, seeing a lot of interest in trying to co-locate new facilities with existing generation. I think we talked about a couple of nuclear deals that were done on the last webinar. We've since had a number of deals with natural gas-fired generation facilities that are, already on the grid, that have been in operation for a while, now adding a new data center behind those locations that'll be configured behind the meter. So a lot of change, a lot of moving around from a federal policy perspective, for sure.
Yeah, and are we, given all of these policy change, I mean, I don't think I'm seeing it, but as far as corporate goals and a shift there, are we thinking there's going to be some delays to corporate sustainability achievements?
Yeah, it's a good question. I mean, I don't know, Andy, you probably have thoughts on this too, but I mean, from my perspective, we haven't heard companies sort of affirmatively backing away from targets necessarily or goals, but perhaps have seen just less sort of announcements, less sort of publicity around things that companies may be doing. Now we'll see if that continues to be the case, or if we do see companies actually start to back away from some of those goals they had put in place.
Yeah, I don't think we've seen a whole lot of it yet, but I think that's right, Matt. The announcements have gone down. The question will be is, as we approach the kind of the new cliff and the ITCs and the PTCs, does that either accelerate, purchases, or does it push people to rethink, their timelines going forward? So I think we'll see some changes here in the next couple of years for sure on where end users end up on that sustainability initiative.
Yeah. Okay.
Yeah, and I think we've heard anecdotally from a lot of renewable project developers that they've seen sort of an increase in demand. They've seen more interest from potential off-takers trying to get offtake secured ahead of the tax credits expiring, and what we know will be an increase in prices once that happens.
Yeah,
certainly from the publicly traded sector.
Yeah, no question.
Okay.
Yeah, so I mentioned earlier some changes on the rules for what sort of constitutes starting construction on these projects, which of course is really important in the context of these new accelerated timelines. So projects that are looking to achieve construction start, quote unquote, as of as early as they can ahead of that July 3rd of next year deadline, they now have less flexibility to do that. So previously, there was what was called the 5% rule. So basically, if you spent, in essence, 5% of the capital associated with the project, then you were considered safe harbor at that point. And there was a lot of ability to kind of move that 5% around between different projects within a portfolio and things like that. That's completely gone now. So the IRS, the Treasury Department, issued new guidance that basically said, no, to truly achieve safe harbor, you really have to start construction. You have to do physical work at the site. You have to do not just ordering of supply chain components, but beyond that. And on top of that, you have to maintain continuous construction. So meaning you can't go out and do, a certain amount of work at a site, walk away for a year as a developer and maintain that safe harbor status. So all of that obviously makes it more difficult both to achieve safe harbor status and to maintain it, and creates a lot of uncertainty. We talked about interconnection delays a lot over the last several years, but when you think about that in the context of these accelerated timelines, adds a lot more risk to developers trying to get projects online, because that's a key element of getting a project to COD that obviously they don't control. So that's something we'll be watching pretty closely. And we have heard from developers that they're definitely looking to, wherever they can, as a result of all these new risks, sort of try to de-risk things that they can control. So that's a key theme that we've heard from a lot of developers for sure. So when you look at the graphic on the left, this shows projects that are in the development pipelines nationwide from a solar perspective. Not everything that's in the interconnection queue, but projects that have sort of advanced to at least a relatively early stage of development. I think when we look at this at a high level, 25 projects, 26 projects, expect all of that to largely proceed as expected. In fact, you could even see some acceleration on some of the projects that are 27, 28, 29 timelines. I think it's really the 27, 28, and 29 projects that start to become at risk, particularly 28 and 29. A lot of uncertainty about how many of those can achieve safe harbor status, maintain safe harbor status, and ultimately move through to completion. So something that we'll be watching pretty closely. So just a quick note on the FEOC rules. That we've talked a lot in the past about some of the incentives for clean energy manufacturing in the U.S. and sort of the build out of especially solar panel manufacturing in the U.S. All of that is good, and it definitely can help deal with some of these FEOC issues. But when you really drill down, we don't have sort of the full supply chain associated with manufacturing solar panels here in the United States. So the graphic on the left gives you a bit of a breakdown of kind of all of the different pieces. So basic raw materials, polysilicon, moving through to kind of the different levels of components before you get to a final module. So from a module assembly perspective, yes, we have a lot of capacity in the US, potentially could meet that demand. However, in terms of all the pieces that go into that, a lot of that is still coming from overseas. So again, another sort of challenge that developers have to navigate to get these projects online.
Yeah, and it feels like, at least I remember the last couple of years, it felt like there was going to be a lot more development domestically, but it seems like that's kind of dried up as well. Some of those projects that were announced have not come to fruition.
Yeah, the tax credits for those types of manufacturing developments have been eliminated via the One Big Beautiful Bill. You know, the other thing that maybe we didn't touch on here is really like, you know, FERC's efforts to try to speed up the interconnection process and whether they can actually make headway on that, and whether that's going to improve, you know, maybe the previous slide a little bit. So hopefully, but it still seems to be mired quite a bit in some back and forth with the individual ISOs at this point in time.
Yeah, and you can definitely see that coming to an inflection point as a lot of these projects, you know, try to hit those deadlines, and the risks obviously are huge. You know, having those credits or not having those tax credits, probably somewhere in the vicinity of a 25 to 40% impact on the finances of a project. So really, really significant.
Yeah, meaningful, absolutely. All right, well, thanks for that update on the policy side. Let's look at gas. This is going to be a pretty fundamental driver in power pricing and market behavior going forward for sure. And I'm sure, you know, it's top of mind for most folks as we head into winter. So let's talk about natural gas.
Yeah, thanks, Neil. You mentioned bullish, and that's it's an interesting comment because I think there's quite a bit of debate on whether that bullishness is actually going to show up at any time soon.
For sure.
You know, if you look at the chart right in front of you, you can see that there's quite an expectation by 26 that we were going to have, you know, some pretty elevated prices due to really LNG and the global commodity that natural gas has now become. That has not necessarily occurred, and so, you know, we're looking at, you know, all 6 tradable calendar years now, you know, below $4, and the out years, you know, pushing closer to 350, and that's really, you know, based on the fact that we've had continuous strong natural gas storage. We're going to, you know, get almost back to the all-time high that we saw last year of just over 3.9 TCF by the end of October. You know, we're like 203 TCF, you know, above 5-year norms right now. Additionally, some of the delays we've seen in LNG exporting has, you know, kind of culled some of that demand out of the market a little bit. Be interesting if it continues with the energy first thought process out there for a lot of data centers. I do think there still is a longer term bullish upside, which might, you know, say that, you know, now's the time to buy natural gas long term. But we're still seeing quite a bit of concerns in trying to get natural gas from the individual basins into the areas where the demand is highest. So, you know, Permian saw a number of negative prices print over the summer. And so it's still quite a bit of, you know, pipeline development that needs to occur to really make this market as efficient as it needs to be to meet the long-term demand that's really expected globally over the next decade or so. Move to the next one. From a supply side, we've had a pretty strong summer. We're averaging, you know, around 107 BCF for September, and we're in the same ballpark most of the summer months as well. Looking at, you know, longer duration, you know, we're expecting 26 will be pretty much in line with 25, which was 25 was just right now averaging just above just under 106 BCF a day, expecting 26 to be, you know, just over 106 BCF a day. You know, a lot of this demand is coming, or supply is coming really with the associated natural gases with crude. As crude prices have decreased, that could put some bullish support as well into the natural gas market, but that has yet to be seen. There's a lot of concern in the oil side of the business right now on whether drill baby drill is the best long-term solution for the market when we're sitting at $60 crude. So more to come on that as well. On the demand side, there been very strong demand as well as supply. So we've hit basically at or higher than what we saw in the 5-year average max every month so far in 2025, with the exception of March. And where we've averaged, once again, a pretty high demand across the whole summer. LNG feed gas has been staying around 16 BCF a day. I think at one point we thought by this time in 25 we'd be closer to 20, but still that's a pretty strong amount of gas going into non-domestic demand at this point in time. So with additional terminals coming online, we expect that to increase moving forward. But yeah, really strong supply and demand thus far this year, and expected into the future as well.
I think we probably have a decent chance of hitting that 20 number sometime early mid next year, with all the new projects that are coming online between end of this year and early next.
That's right. That's 100%. And then from a storage perspective, as I mentioned earlier, we're going to probably get close to 3.9 TCF by the end of the storage season, which is right in line, just a few BCF below where we were this time last year. With increased supply coming out of the markets and the basins this year, and that not seeing that LNG export be where it was expected to be, we've had a lot of opportunity to put natural gas into the ground. Regionally, it's been very strong across most of the region. The Midwest is a little below, as well as the East, but overall the South and South Central, which is where most of the natural gas, movable storages that you can put in and out throughout the season, that's remained pretty high, above the average, and really staying on point for reaching that 3.9 TCF goal by the end of the October period. So all in all, natural gas storage is very robust at this point in time.
Yeah, I'd say so. And it was not that long ago that those regional capacities were more on the minimum side, pretty tight, from what I remember. And certainly good to see that production remains, and storage is pretty ample at this point.
Sure. Yeah, it looks pretty good going into the winter right now.
Yeah.
So.
Yeah, absolutely. All right. Well, should we shift to the market? Certainly plenty to talk about across all the different ISOs, and certainly coming out of summer, this tends to be an inflection point in each space. So let's cover that.
Yeah, for sure. I think it's probably good to maybe start out with a little bit of an update on weather. And looking at these maps, I mean, it looks like golf weather for pretty much everybody across the country, right?
Good news. Yeah.
Get those rounds in before it gets cold up north. Of course, here in Houston, we don't have to worry about that. Golf season is year round if you can deal with the heat.
Like this map's been red all year long, it feels like.
Yeah, it has.
Yeah, I still do wonder, like, where we say this is above, compared to normal. What is normal anymore, right? I mean, or do we need to adjust normal, because it does seem like it's always warmer. But in any event, near term, very mild. I think just from a overall demand perspective, both for power and gas, this would tell me that the next sets of weeks, and we're kind of seeing it in terms of near term gas prices, and for that matter, real time settlement prices, pretty mild, right? So a relatively quiet period of time seasonally, but in addition, not seeing any of that early season cold yet up in the northern part of the country. A little bit longer term, so this kind of takes us through December. So sort of think first half of winter outlook, kind of the same theme. I mean, relatively mild, generally speaking. Expectations for temperatures to be generally above average across most of the country. The precipitation side, maybe a little bit more concerning in the south, given that we expect lighter levels of precipitation than what we would typically see, which, the concern there is obviously as we begin to think about heading into next summer, are we set up for, any type of drought across those areas, which usually tends to lead to higher summertime temperatures. But at least for the near term, I think all of this would indicate, relatively bearish, both from a gas and power perspective, at least for the near to medium term. So jumping in and kind of talking about the different ISOs and what we're seeing there, we'll start with ERCOT here. We're going to do a pretty good deep dive on summer, so I'll hold comment on that and let Andy talk about the summers for each of these ISOs. But just to talk high level about some of the things that are happening within each market, within ERCOT, big story obviously continues to be demand growth expectations. When we started the year, ERCOT had about 72 gigawatts. That's gigawatts, so 72,000 megawatts, almost double the peak demand of the grid in the interconnection queue of new large loads. That number is now up to 190 gigawatts, which is obviously staggering. As we know, not all of that will get built. We know there's duplicative requests within that number for sure. But nonetheless, even if 20% of that number is built, it is a major shift for the ERCOT market without doubt. And a lot of work is being done. Senate Bill 6, obviously, that was passed over the summer. A lot of that is in the implementation process now, trying to work through a variety of issues around getting all of that load to the grid. Another update from a regulatory perspective. So ERCOT is planning to adjust its ancillary service procurement plan for 2026. The long and short of it is that they're likely to be procuring more ancillary services, particularly in the sort of high demand periods or high net load periods. So the periods where you have higher quantities of renewable energy as a proportion of overall supplies. Probably going to lead to somewhat higher ancillary service and energy prices. If you think back to 2023 when ECRS, one of the new ancillary services, came into the market, that pulled a fair amount of generation capacity out of the energy market. And so you not only saw ancillary prices go up, but you actually saw the energy prices go up as well. So something that we'll be watching as we head, especially into the summer of 26. And then another note of something that's coming up, a change that's coming, real-time co-optimization of the energy and ancillary services markets. That is on track for implementation in December of this year. So very high level, basically what that means is you'll have generators bidding into the ancillary market and the energy market, and ERCOT sort of dispatching all of that, both the ancillaries and the energy in real time. So the hope is that will lead to some efficiencies, because today the ancillary service market clears on a day ahead basis. And essentially those units are, not under consideration for energy production. But you can see here forward prices, continued focus on load growth, remaining kind of in an upward trajectory generally, even though, as Andy will talk more about, we had a relatively mild summer, at least from a power market perspective. You can definitely see the growth in solar generation and the fuel mix on the right, continuing to see that increase as new capacity comes online. Yeah, Andy, tell us a little bit more about what we saw this summer.
Well, as we talked about on the couple slides back, we are expecting it to be above normal as it's been most of the year. And generally speaking, it was June through August. I don't have September in here because we're closing it out today, but ended up basically, slightly above normal. Really driven by, the late June, July heat that we saw. But overall, it was milder than we've seen and certainly milder than 2023. If you look at the cooling degree days down there, it doesn't show a whole lot of, variability there, but you can certainly see that 23 kind of has the standout there for both July and August period. And 2025 is kind of right in the middle of those 4 years. But certainly we've seen warmer years the last decade or so than we have versus historical norms, and that continued this summer as well. Looking at the load impact side of that, some of this is driven by the heat, but really I think this is a lot driven by the additional just load growth that's coming into ERCOT. If you look at the curve there, you can see that 2025 is the highest across really like our beginning midnight through about, hour, like 1 or 2 o'clock in the afternoon. And then all of a sudden it's basically the same as the 2023 kind of average peak hours. This is the average peak hour across the summer, not like a particular day or a particular month. Really that's driven by, two different, major implications. One is additional load growth of non-weather sensitive load, i.e. data centers, crypto miners, those that don't really have a whole lot of impact because of air conditioning, because they're already air conditioning all the time to keep those servers at the right temperature. And then secondarily is the curtailment availability from a lot of the crypto miners and the 4CP reduction that occurred. You can see right there, we've got, over 4.5 gigawatts of reduction during the peak hours coming from both crypto miners and 4CP. That's really the biggest thing is we're seeing more growth in the overnight and less during the peak hours, which, we would have had an 88 gigawatt, demand this summer versus what we actually saw, which is like 84, if we had not seen that reduction across 4CP and crypto mining. So all in all, we expect to see continued load growth across, all hours, but really the overnights are starting to lift a lot more than the peak hours. Fortunately, that same load is heavily supported by renewable generation. We've seen a almost tripling of the available capacity and resultant production from solar between 2022 and 2025. You can see that blue bar at the bottom down there on that chart versus the orange. That's a significant increase in available daytime generation capacity. So much so that solar was the second largest source of supply in August of this year, and surpassing both wind and coal, and then also met about 15% of the ERCOT demand thus far this summer, June through Aug, once again surpassing coal. And then wind and solar combined, though wind hasn't changed much, since 2022. You can see a little bit of an uplift there, but overall it's been pretty flat. They combined for almost 34% of the supply stack this summer, which is a significant increase from where they were in 2024. So, renewables definitely helping to keep a lid on price formation the last 3 years. Speaking of price formation, once again, high supply and slightly lower than expected temperatures. We resulted in a mild summer, maybe the wrong word, but a not aggressive summer in terms of temperature, but certainly a mild summer for prices. Slight uplift versus 2024, but averaging only about $33 across the June through Aug, on a 7x24 basis, which is very low. Also, a lot less volatility than we've seen, with mainly because of the solar capacity, and then the battery capacity in conjunction with solar, allowing us to kind of move some of that peak solar into the that afternoon ramp out hours. Kind of think about 6 to 9 p.m. No, sorry, 5 to 7 or 8 p.m. Really helping to keep that lid on that demand area. And then what's been really interesting is watching the average peak hour move. So in 23 and 24, that was an hour beginning 19. And it's moved to hour beginning 20 in 2025, even though that peak was significantly lower in terms of overall price. I mean, you're talking about a $46, $50 price versus, over $100 in that previous hour peak. So pretty substantial difference there.
Yeah,
and it's amazing. Oh, go ahead, Neil.
Sorry, I was going to just say that $33 average, I don't know how September shaped up yet, but if I remember right, this is the second year in a row that May was actually the highest monthly average in the year, which is, all kind of new trend that we're not used to.
Yeah, no I don't know that one off the top of my head. We probably go back a couple slides and look at that, but I think you're certainly in the right vein of direction.
Yeah, I think that is right. Yep, May was highest so far this year, for sure.
Monthly average.
Yeah, and I mean, going back to this graphic on the bottom right, it's fascinating to me because I think the headline from everybody was, the last 2 years, ERCOT, no new peak demand, load's not really moving up that much. But when you really drill in, the load is moving up. It's just a matter of the hours, right? And when that's happening. So yeah, pretty interesting for sure. Great. Well, shifting gears and talking about PJM here, a lot going on in this market as well, as is the case, it seems like, in most of these markets. So a couple headlines. Capacity auction was conducted in July since our last webinar. So I'm sure a lot of you have probably already heard about this, but we did have the prices clear at the newly implemented cap of basically $330 a megawatt day. So a lot of angst about that. I think when that cap and floor was put in place, I think the expectation was that hopefully prices would land somewhere between the cap and the floor. But, in fact, they cleared at the cap. And I think the indications were that if the cap had not been in place, those prices would have cleared close to $400 a megawatt day. So really, really significant in terms of cost impact, getting a lot of attention from policymakers. As you note there, the governor of Pennsylvania called a meeting of governors across PJM. Basically, he has been a vocal critic of PJM because of these high capacity prices, because of other, market distortions. I think this is a theme that we're going to see over the next sets of years as you have uneven demand growth. You have certain markets that, are seeing really significant demand growth, and then other markets that maybe aren't seeing as significant a demand growth. And the need to build out infrastructure. What happens within an ISO is a lot of that infrastructure cost sort of gets socialized. So the sort of risks of, you build the infrastructure and then the load doesn't come in where you expected, that's getting sort of shared across consumers that maybe aren't seeing the economic benefits of that demand growth. And likewise, from a generation perspective, different states have different policies that incentivize renewables or other technologies over others, and that sort of gets harder and harder to navigate as you have divergence in those policies. So a lot of stress that PJM is under to try to keep everybody together and kind of keep the ship moving forward.
Yeah.
I do think that there's going to be a disproportionate impact to PJM in terms of the loss of the tax credits for renewables. You think about it, I know that's a theme we've talked about for a while. PJM was probably the most challenged in terms of interconnection delays and a large backlog of projects. That is starting to get better, but now you add these really accelerated deadlines. I think developers are going to have a lot of concern, a lot of challenges in feeling confident that they can move forward and those interconnections will happen on time. So it'll be interesting to see how much of the backlog of projects does ultimately move forward. So Andy, you want to tell us about summer in PJM?
Sure.
You visited up there this summer, right? You took a little vacation up in PJM.
I did. I was up in Allentown, Pennsylvania for a week. It was really nice. Not super hot when we were up there, but as the theme you've heard so far is that it's been above normal and it forecast to be above normal, and it was above normal up in the PJM area, but with quite a bit more volatility in the heat extreme. So I don't know if you remember back to the last week of June, first week of July, we had the heat dome. That was probably the most extreme heat that they've seen there in a while. You can see it in the cooling degree days down there that the June number is substantially higher, while July looks kind of on normal. But that drove a 6 gigawatt divergence in the forecast on June 24th when they hit 162 gigawatts, expecting something closer to about 156 gigawatts. So that was an interesting day, and some pretty high peak prices on that day as well. But in a little bit of a juxtaposition versus ERCOT, PJM has not had the load growth historically. If I went back and showed the same chart 10 or 15 years in a row, you would see a very flat profile, up until really this year or maybe last year. But PJM is now forecasting about 2% load growth every year, probably for the next decade plus. That's really driven by, a lot of the data center expansion, electrification of vehicles and industrial loads. And then this year they had quite a bit of elevated overnight temperature. So kind of flipping back and forth between the two, while we saw this extreme heat, we didn't have massive numbers of days of really high temperatures. What we had was not a lot of low overnight temperatures, which led to a higher overall lift in both load, but also just in prices, which we'll see in the next slide here in a second. But overall, PJM is expected to expand rapidly over the next decade, and this is just the first step in that, moving from 24 into 2025.
Yeah, and Andy, you talked about curtailable loads in ERCOT and sort of the volume of peak demand reduction that we saw, really trying to avoid 4 coincident peak periods in ERCOT. I'm wondering if I know there's already some of that goes on in PJM, but now that the much higher capacity prices, there's obviously a lot more incentive to try to avoid those 5 coincident peak periods for sure.
Yeah, certainly. Yeah, that's definitely something you would expect to see going forward. And they certainly don't have the crypto load up in PJM that they have in ERCOT. So a little bit different from that perspective as well. So
yeah, and further to that point, we didn't have this on the last slide, but PJM has put forward a proposal to kind of address some of that demand growth that would basically create almost a new category of service. You would have new large loads coming to the grid that were not required to procure capacity, but in turn would also be curtailed during periods of really high demand on the system. So that could also have impacts to sort of how this overall load growth shape and load growth sort of perspective looks over the next sets of years. I think so far that's been met with largely negative feedback in terms of how that would work, both from the generation and the consumer side. So we'll see where that ultimately lands.
Yeah, it's interesting. And then looking at the renewable generation, PJM certainly doesn't have the proliferation of solar and wind that ERCOT does, but they have doubled or tripled their solar capacity since 2022 now into 2025, which is pushing them up into that 10 gigawatt hour kind of peak output during a summer day. Wind, on the other hand, like I mentioned, ERCOT also been fairly flat, not a lot of development in wind over the last 3 or 4 years. But combined, wind and solar met about 5% of the supply this summer, June through August, which is just up from 3% in 2022. So that's a good move in the right direction. And right now, PJM is forecasting integrating up to 100 gigawatts of renewable energy over the next 15 years. we'll see how that goes with the OBBA or whatever we're calling it now, triple BA. I don't know the right word, but
OB3.
but
OB3,
there's
it's a Star Wars character.
yeah,
O
isn't
triple
that,
BA. I mean, that sounds like a 90s hip hop group or something.
I don't know.
I can't use that
You
one.
say it better than I do, I think. But that certainly is, an area where PJM has a lot of opportunity, given that, as Matt mentioned previously, the capacity prices up there are, at a cap of, roughly $300, I think, or something. So it certainly needs every kind of generation capacity that can get into its mix to help, provide reliable power on an ongoing basis into the future. So certainly an area that we're keeping an eye on. And then from a price formation perspective, quite a bit more volatility this summer than the last 2 summers. Prices increased across all hours. And we're starting to see, which is interesting, though there's not much renewable there, a little bit more of a duck there. I think that just has to do with the fact that it gets a little warm coming out over the overnights, and then the ramp kind of phrase down there. But overall, we did see a shift in the 3-month average peak hour. The summer peak hour moved from hour beginning 17 for the last 3 years to hour beginning 19. So as more and more renewables come online, and batteries have come online, we're seeing that peak hour move further and further out. Overall, the prices here were not way out of control, but much more in line with 2022 than we've seen in 23 and 24 the last 2 years. So that kind of makes sense given the capacity prices have increased, and there's a tightness in the reserve margin for the first time in PJM in a long time.
That's a big shift in just a year. I mean, that peak price moved back almost, or I guess that was from 2022. So a three-year time horizon, but really it wasn't much different in 23 or 24.
They were all the same.
Shift.
Yeah. 22 to 24 were all hour beginning 17. So that is a big shift. Yeah.
Interesting. Yeah. Definitely we'll see that keep moving with additional solar coming over the next at least 3 years for sure.
Yep.
Great. We'll move into CAISO, a good place to talk about the impacts of solar generation for sure. So a couple of notable developments here. California's been pretty active on the legislative front recently. So they passed legislation called Pathways legislation, basically to create a new regional transmission organization that would oversee CAISO's Western Energy Imbalance Market. So for those not familiar, this is basically the imbalance market that CAISO runs that spans a number of different utility territories across Western states, trying to sort of bring those together and more efficiently dispatch generation across the region as opposed to just within CAISO. As well as what CAISO will be going live with next year, which is the extended day ahead market. So a lot of work still to be done there that has to get federal approval, and a number of other sort of hurdles have to be met, but potentially, look to see another RTO coming to the Western market, and kind of think about this in competition with SPP's Markets Plus initiative that brings in areas of Colorado and New Mexico and some other places into that RTO from a sort of energy imbalance market perspective. Not full integration, because as you probably know, there's limited interconnection between the Eastern and Western interconnections in the U.S., but has the potential for that to maybe grow a little bit in the future. Wildfires continue to be a big theme in California, big area of concern, obviously, particularly from a utilities perspective. Utilities have sort of seen a lot of challenges around that in terms of wildfires that their equipment has been linked to. So there was some new legislation that basically tries to push some of that risk back to the utilities, in essence saying, look, the monies that you all spend on wildfire prevention, there's going to be limitations on profits you can earn on that spending and those investments. So trying to sort of move the needle from a financial perspective off of ratepayers. Notably, the state did also end funding for its virtual power plant program. I think there's a lot of concern in that in terms of sort of losing a flexible resource that the state had helped to support over the last sets of years as they integrate more and more renewables into the grid. So we'll see if that ultimately changes, but obviously a victim of budget pressure within the state. And CAISO is definitely not immune to the load growth phenomenon. So PG&E had reported earlier this year that they have about 10 gigawatts or more of new capacity under study within its territory. And that's just the PG&E area alone. So you can imagine there's probably, several more gigawatts across the different cooperative territories, Southern California Edison and SDG&E as well. But definitely expect to see growth from a demand perspective there, as well as, electrification and some of the other themes that we've touched on. Vandy, tell us about summer in CAISO this year.
Well, once again, the same theme of above normal forecast and slightly above normal actualization does occur. However, California had a little bit of a mixed bag this year with the very impactful coastal marine layer that really, kept certain coastal areas, fairly mild relative to some significant inland heat. So a little bit of a contrast there, depending on where you were in the state. But overall, it just got a little more hot every month. So, while June was, probably a pretty average month, July, a fairly average month, it got a little warmer as we moved through until August. So, overall, it wasn't anything, massive, but it was slightly warmer than normal, with quite a bit of volatility in the heat and the cold, kind of a different mix there. But from a load side, in contrast to what Matt just said, we are not seeing a lot of load growth actually materialize to date.
That was a bad segue, wasn't it?
Yeah. Well, I mean, it does make sense that you would see it, but really, I think it's a lot of the behind the meter solar and battery storage are helping to kind of keep some of this from actually showing up in the grid. So, as prices in California have increased over the last decade, a lot of people have taken the opportunity to put in, capacity that allows them to stay off the grid as much as possible, which that's keeping the demand from actually showing up. Additionally, they have significant funding for energy efficiency and demand response, which is helping to keep load out of peak hours for sure. And then we've seen, load leave the state. If you think about a few years ago, you had Toyota and a couple other large companies that have left the state, which is certainly impacting the load growth there. And electrification is on its way. California leads the country in terms of EV, as well as moving away from natural gas heating and cooking into all electric. And that will certainly begin to show itself as we move further into the latter part of this decade and in the next decade. But all in all, pretty big difference from previous years to this year. On the renewable generation side, California was, was probably the first state to have a significant utility scale solar and wind development program. They're starting to slow down relative to the others that are starting to grow. So, they doubled in solar development between 2022 and now, but the growth from year to year has kind of gone a little slower than maybe ERCOT and PJM have the last couple of years. Roughly 30-ish gigawatts of wind and solar combined. But battery installations is really the big number, I think, that's kind of stuck out to me. So about 15 gigawatts have been installed since 2022, which means that they've got, approximately during the peak generation hour of solar combined with wind, you've got ability to basically shift about 2/3 of that generation to a later period of the day. Which is significant. We're certainly not there in ERCOT or in PJM by any means. And I think that is very evident that is occurring. If you look on the chart on the right, and you can see the orange line for 2025 is extremely flat. The trough and the peak are within about $20. And looking at it, even the overnight prices, I'm kind of skipping around on my bullets here, but the overnight prices for the summer on an average basis range between $37 and $44.50, while the peak hour averaged $46.97. So not a lot going on overnight in terms of price change from the peak hour. But once the solar comes offline, the batteries step in and kind of defray some of that solar into later hours, and then the thermal generation kicks in and provides power overnight to meet the load requirements where the wind can't keep all of that. So it's kind of interesting to look at that relative to the other markets, but it's almost not a duck anymore. It's like a minor wave at this point in time if you look at it under this lens. Obviously, springtime still has a massive duck occurrence, but all in all, CAISO is up a little bit relative to last year, with the exception of the peak hour being significantly, discounted to previous years. If you can look from blue to green to brown to orange, it's just come down massively from a peak hour perspective.
And you talked about the impacts of battery storage. I think one thing that we've been really focusing on is the duration of battery storage really matters. And I would say, generally, and correct me if I'm wrong on this, I think our view is that the majority of the battery storage that's been installed in CAISO would be 4-hour duration, contrasted to an ERCOT that, generally, I think we've mostly seen 1 to 2-hour duration battery storage coming to that market. Fair statement.
That's entirely correct. And we've even seen people touting 8-hour lately, but that is extremely expensive.
Yeah. Definitely has an impact in terms of, sort of what's the duration of those events that battery storage can really help you navigate. In Texas, still have some maybe exposure when you have sort of those really hot summers and the longer periods of higher demand during those solar ramp out hours versus California that has more of that longer duration capacity today.
That's right. Yeah, it kind of begs the question of like, who's going to build capacity when it's $40 round the clock? Like, how do you get that, return on investment without it being renewable? I don't know. It kind of makes me wonder a little bit, but
that's probably the $100 billion question, right? That across all these markets.
I'd take it for $100 million, but I don't have an answer for that yet.
A lot of potential investment coming. That's for sure.
Yeah,
sure. No doubt. Well, good stuff. Well, last we were going to just do a quick update here on MISO. Number of things that are happening in this market. So I guess first off, one also with regards to capacity market. So MISO has identified that there was a software issue in this most recent planning reserve margin or BRA auction that basically caused capacity prices to clear higher than what they ultimately should have. The error actually goes all the way back or impacted auction results all the way back to 2017. So if you think kind of through the history of capacity rates over the last several years, we had some years where rates were pretty high, and this issue definitely had an impact. However, MISO's tariff only allows them to go back a year, so they are planning to provide an adjustment for the 25-26 planning year. I think the overall order of magnitude is about a $280 million impact market-wide. So, not giant when you think about that market-wide, but certainly impactful, especially against the high capacity prices that we've seen in this last auction. Notably, this issue, in essence, won't be an issue again in the future. So the issue really revolved around MISO considering measuring sort of outage probabilities across all hours instead of only across peak hours. However, MISO had already planned to move to an all hours calculation for the 26-27 planning year. So all of that is to say, don't expect, they're going to fix the software issue and then that's going to see some relief on capacity prices going forward, because in essence, they're going to be keeping the same methodology. It was just an error to have been using that in the previous auctions. So we'll see if there's any kind of litigation or further action on that. But for now, just adjustments to the 25-26 planning year. MISO did receive approval for its proposed fast track process. If you remember, they had a proposal into FERC that got rejected. They went back and revised that proposal and did get approval. So they're now in the process of working through trying to get some of those basically assets or generation assets that they've deemed necessary from a resource adequacy perspective, get them into the fast track process and get them online sooner than sort of the general interconnection process. But just a quick view in terms of summer, we don't have the sort of detailed drill down for MISO that we did for the other markets, but definitely saw some growth in solar generation, as you can see from the fuel mix slide there. Interestingly, we did see an increase in coal generation, which of course was not building new coal plants and those coming online. Really, it was more gas to coal switching, utilities and merchant generators basically running the coal fleet at a higher level, particularly earlier on in the year when we had higher natural gas prices and sort of natural gas not running as much, as a result of those favorable economics for coal. So not new coal capacity, but just higher utilization of the existing coal fleet. From a price perspective, kind of similar to PJM. I mean, we did see some elevated prices across the summer months relative to what we've seen. The last couple of years, certainly 23 and 24 were uneventful, but 25 with some of the heat waves that we saw, particularly in June and July, definitely saw some relatively elevated prices across the market. And from a forward market perspective, the graphic in the bottom left, continue to see sort of that general upward trajectory in prices. Nothing extreme, but I think it again sort of illustrates just the perspective that the market has today, which is, not a lot of concern about relatively low spot prices, but more focus on expectations for demand growth and the potential that those prices will be higher in the future. So I think that brings us to, Q&A time.
Yeah. So I think one thing, and I don't think we covered it, certainly with Texas legislature meeting this year, there was a lot of power focused bills. Luckily, only one really got through. That SB 6. Let's talk just for a minute about the discussion around changes to 4CP in ERCOT.
Yeah, a lot of activity.
I should say.
Yeah, that was one of the pieces of Senate Bill 6. So a number of things, just high level on Senate Bill 6. So dealt a lot with the process for large load interconnection. So trying to sort of firm up what that looks like, what it requires in terms of security deposits and different studies that have to be done, things like that. So that's one work stream that the PUC is working through on implementation of SB 6. Another one is co-location of new large loads with existing generation assets. I mentioned that earlier. The PUC is working through trying to put in place a process to either approve or reject those, or what most likely will be the case, which is approve with some conditions. And there again, some of the issues that have come up are things like the requirement that generation that basically comes off of the grid and goes to serve a large load, that same generation could be called on to produce its full output, meaning in essence, you'd either have to curtail the load or the load would have to have its own backup generation capabilities. So that's also moving around. But as you said in the question, Neil, so 4CP or 4 coincident peak, basically the current methodology for allocating transmission costs in ERCOT, that is another one of the work streams. SB 6 basically directed the PUC to relook at that methodology, determine if that's a reasonable way to allocate transmission costs or if changes are needed. Not the first time that's come up. That's come up before in some utility rate cases and other discussions. Largely because there is a significant amount of load, as Andy noted in his slides, that does curtail to try to avoid those 4 coincident peaks and avoid or at least reduce transmission costs throughout the year. So the PUC's basically gotten a number of different, they've kind of put out questions to get comments back from market participants. Got a wide range of opinions on it, a lot that are in favor of keeping the existing system, a lot that are in favor of, on the other end of the spectrum, moving to something that's much more granular, like a 365 CP or even a 12 CP, where you basically are measuring demand, daily, or you're measuring demand, once a month. I think it seems like there's a lot of momentum behind, something that would be incremental. So perhaps adding a winter coincident peak season, that got a lot of attention. Maybe 12 coincident peak season, or maybe just staying with 4CP. I don't think we have good sort of line of sight yet on really where the PUC might be leaning on that. But definitely, I think the bill calls for them to reach a decision on whether they're going to do anything or not, and what that change would be by the end of the year, I believe. So we should see some more action on that coming in the next sets of months.
Yeah, certainly something to watch for. Well, I think we're getting close to time, so I'm going to use these last minutes to thank everybody for joining us today. Thank you, gentlemen, for all the insight, and certainly to our audience. As you are looking at your energy strategy, certainly reach out. We're happy to accommodate and help you form, a strategy for decision making in light of all these multifaceted fundamentals influencing energy markets today. So with that, I will thank you again and hope everybody has a good rest of the week. Take care.
Appreciate it. Thanks, Neil.
Thanks, everybody.
Thanks, Matt. See you guys.